This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
All right, Nick, let's get to these charts. On page 2, we added a new chart on the SPX, just showing all of these support resistance levels. So going into that March OPEX, what levels are you watching?
Yeah, so listeners, looking at the green box on the screen right here, this denotes the expected range based on the option pricing for the March 17th option expiration. So as you can see here, current spot is 39.91 roughly, so around that 4,000 level, which is a very key level. The upside for the March 17th OPEX is to 41.46, and the downside is to 38.36 approximately. So looking beyond that, we have support levels at 3,800, 3,700, and 3,500, which are previous support levels. And above that, we have resistance somewhere around 4,000, which we're at right now. So again, very key area right here, make or break. Above that, we have 41.20. And then 43.25, which were the highs back from August of last year. Now, looking at these levels, it's very important to analyze because if we break down from the 4,000 area, then obviously we have 3,800 in sight. And if we break above it, then 41.20 is in sight again. But Eric, based upon these levels, what are your thoughts here?
It took a while to get through resistance at the 200-day moving average, which is where a lot of bear market rallies tend to fail. So now the big question is whether this is a bear market rally that was meant to fail at the 200-day, and it's going to go back down, and we're going to see a close below the 200-day, or it could be that this is just a very common pattern we see in technical analysis, where it took a while to get through that 200-day. We're going to now take what was a very important resistance level, go down and test it as support before seeing that support level hold and the market moves higher into a new leg, perhaps up to 4,300, which would be the 61.8% fib retrace. I don't really have a strong opinion on which way it goes, but the question in my mind is whether or not we see a daily close below 39.48, which is where the 200-day moving average is right now. That would be probably the best indication if we do see a number below that on a closing print that this was a false breakout and maybe we are headed considerably lower. We'll see what happens, though.
So, Eric, on page 3, where I have that chart of the S&P 500, what I did was I drew on the ascending trend line and that 50-day moving average on there. I know you watched that 200-day moving average. It's right in this zone as well. And this is actually a very typical and key pullback. Now, obviously, many people are getting nervous and bearish about this breakdown. But typically, once you have a trend of higher highs and higher lows going, the first assumption has to be that the support level offers at least a reaction. And so reflexively, a rally back to 4,100 or higher is a typical reaction. What we'll be watching is whether or not this market cycle is done. If the support level holds here and we get a north of 4,100, we could certainly still take a stab at the 4,300 highs where the August high was. And it would certainly allow the market going into the middle of March to stay in this prevailing trend that's been so dominant since October. The big question, of course, is when will we inevitably have a sell cycle, and is it happening now? In my mind, the beautiful thing about this 4,000 level is that it's a beautiful, very clean round number pivot, and it's really simple. If the bulls can sustainably keep it north of 4,000, then you have to respect that the trend that's been in place of higher highs, higher lows, and the market crawling higher will remain dominant, and that's certainly what to keep an eye on. All right, so on page 4, Nick, we have that QQQ, and what option levels are we looking at going into that March OPEX?
So listeners, in the same way that we looked at the green box for the SPX chart, which denotes the expected range of movement based on the option pricing for the March 17th OPEX, we have a spot price on Qs of around 296 right now. Expected move is about 16 points in either direction, which is about 5.4%. So the upper expected move is around 312, and the lower expected move is around 280 or so. Now the resistance above would be at 320, then 330. We're at a key level as well of 296 area or so, which has previously acted as resistance and support. And then beyond that, we have support below at 260, which is, far below the current area, and then at 254. So looking at these levels, kind of important because, again, just like the S&P, we're at a very, very key inflection point here where we could break up again back to new recent highs, or we could break down again and test out those lower areas around, 260 or so.
Yeah, Nick, it's really interesting about the Qs because obviously the NASDAQ in the last couple of months has really been a short-term outperformer, a sector rotation out of the defensives and into these higher beta names really has been prevailing. It'll be really interesting to see if that trend continues. So moving on to page 5, we have that VIX, and certainly we were in this trade range down in the high teens during the market rally, and really the last few days when the market broke, we saw this spike in the VIX up towards 24 on the upper boundary. And this is really interesting to see whether or not the 4,000 level on the S&P holds with elevated levels of VIX. At this moment, if we just see the S&P bounce and the VIX fade back to 20 in my mind, then it's just nothing more than the typical kind of market correction and a quick little jump in VIX that we have seen over and over again. What levels are you watching though, Nick?
Yeah, again, so the spot right now on VIX is 21.86 roughly. So that denotes daily expected moves in the broad markets of about 1.35 to 1.4%. And as you said, we've broken up again recently above that 20 level. If we test the 25 area and break above that, then chances are we're going to see a decline in the broad markets. But if we pull back down to below 20 and test out that 18 range, it's possible to see a slow trickle higher. Given that we have some events coming up in the next few weeks, namely FOMC again with a possible rate hike again, a probable rate hike rather, it's likely we see volatility elevate into that event. So I'm kind of being a bit cautious here and a bit more risk off after the recent rally. However, if you're long-term positioned, it's important to look at your portfolio in aggregate, perhaps thinking about ways to hedge, which we can discuss another time. But for now, again, the key levels are 20 to the downside. If we break below that, it's probably we're going to see a slow trickle to the upside in broad markets, and 25 on the upside on VIX. If we break above that, as you've seen the chart previously over the past year, we've ran very, very high, very, very fast, which has also coincided with substantial declines in broad markets. Now on page 6, we have the US dollar index. What are your thoughts here, Eric?
We've had 2 daily closes in a row now over the very important technical level of 104 on the dollar index. So far, though, no acceleration in upside momentum. The jury's still out on whether the dollar moves higher from here. A close below 104 or an acceleration of momentum to the upside would be the tell for where the next leg is going to take us.
Yeah, well, Eric, in that post-FOMC minutes, we certainly seen once again another uptick here on the dollar index, working now above this 104 level and back to the highs it had from last week. This is the trend that continues. The dollar was so incredibly oversold, and it was way overdue for some mean reverting correction. This could easily work its way to 106, 107 as we see the euro below the 107 level. We could see 105 on the euro or lower. We can see the yen also, US dollar yen, working its way higher here, and it just continues to be on the short term a little bit of a counter trend. What is yet to be determined is whether this is a bigger, deeper, a more meaningful rally in the dollar, that one that could potentially go back to its highs. It's very premature, and certainly the price action has almost little to no momentum yet, signifying that somehow a really big dollar move is underway. But one way or another, we're above that 104 level you just talked about, and 106 is a very reasonable short-term target.
Now on page 7, we have the chart of gold. In the interview, gold was mentioned for geopolitical reasons. What are you thinking about gold here, Eric?
Well, we're in the midst of the biggest geopolitical escalation since the Cuban Missile Crisis, and gold, which is supposedly the ideal hedge against geopolitical risk, is down on the news. Go figure. I think the message is pretty clear that the gold market is being driven by real interest rate expectations and ignoring everything else. At least that's my interpretation, considering that a hawkish outlook from the Fed on Wednesday seems to carry more weight for the gold market than Russia rearming its submarines and warships with nuclear warheads for the first time in 30 years. What happens next for the dollar index will almost certainly be the tell for what happens next in gold, obviously in the opposite direction.
Yeah, Eric, a lot of macro traders do talk about real rates being a driver here. But the one thing that cannot be denied is the fact that gold continues to simply behave as a cross currency to the U.S. dollar. And then we continue to see the U.S. dollar crawling higher and gold giving it back. I mean, that reversal that occurred on the top of gold was literally to the day when we saw the bottom of the dollar. And while certainly geopolitics and the escalation of the situation may allow gold to actually demonstrate some degree of relative strength and potentially a rally, at this moment, all we're continue to see is that it just is behaving in that inverse relationship, and we're going to be watching whether that breaks. On the short term, I think the fib zones around 1800 to 1750 are realistic downside targets if we saw the dollar index go to that 106 plus level on the upside. But overall, I remain quite bullish gold in the bigger picture, but we simply have to see when and how far the sell cycle actually plays out. Moving on, though, to page 8, Eric, I put on this chart of crude oil. And the thing that I just wanted to observe is from a price action perspective, this remains incredibly weak. Every rally that we've seen always lasts these 3-4 day bursts, barely ever is able to make it back to its previous highs, and almost immediately is distributed back to the lows. And this distributive price action has been dominant for like 7-8 months now. And while at some point there's going to be a meaningful rally in crude oil, there's certainly the backdrop from it from a macro fundamental perspective, but there is simply no evidence right now that some new accumulative cycle has begun. With so many tests of its previous support line, at this stage I certainly wouldn't even rule out a short-term trip to a lower low just to wash out some stop losses and to make some headlines. But overall, it's one of these scenarios where oil's probably cheap. It's probably a half decent level to own, but there's zero evidence that it's imminently going to start on some sort of new bull trend, and sort of stuck in the gutter, if there's any other way to describe it. So moving on, page 9, I wanted to just put up that chart of natural gas. And what we have here is just an ugly sell-off. And here in early February, it looked like natural gas was even basing along the 25 level. But that has simply not held. And the distribution continues. So many traders out there talking things like negative levels for Nat Gas. Sentiment is starting to emotionally break as traders are being washed out of this trade. It'll be really interesting to see when inevitably we see a tradable low, but there is zero sign of it right now. Yesterday was a little bit of a reversal off the low, but there's certainly nothing for bulls to be able to lean on yet in terms of some sort of a tradable low. Finally, I wanted to just touch on those the 10-year and 2-year Treasury yields on pages 10 and 11. And the key observation is while we have seen the 10-year yield working its way now back to those December-January highs, slowly approaching 4%, where we continue to though see the real pressure is in that 2-year yield, which is right back to those October highs near 470, and really feels like we're about to see a fresh new high as the hawkishness towards the Fed policy and how far they're going to go is starting to be now baked into this 2-year yield. It'll be interesting to see whether or not those 2-10 spreads continue to actually become more and more negative in this type of environment as we move forward.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.